Hi, my name is Anuj Gupta. I'm from TAG Investments. We are a wealth management, taxation, insurance, investments, and advisory firm. Today, we are going to talk about how money works. This presentation is for information purposes only and does not represent any financial or any other advice. Well, generally, we all invest for making profits, but we say that investment is not done for profits but for prosperity. Prosperity for you is equal to wish, wealth, and wisdom. Well, post this lockdown and the COVID-19 crisis which we are presently in, we've witnessed a change which is shifted from wealth to health. So people have started encouraging and taking care of their health before they can take care of their wealth. Also, the social human which we are, it has shifted to number three, in which we were number two. Well, we're going to talk about how money works, and first to understand how money works, we're going to talk about money management. So the sources of earning can be through a job or through business. The spending which we do is in basic needs and lifestyle. In savings, we can save through FDs, fixed deposits, post office, gold, silver, buy some insurance with returns, debt funds, liquid mutual funds. In investing, we can segregate it into real estate, equity mutual funds. This is how one manages money. We also need to understand the investor investment cycle. So the black line which you see, that's a straight line, typically a fixed deposit return, whereas the blue line is what you see as the equity based returns. It is witnessed that whenever the markets are down, that is when the investor is in need of money and he withdraws. But he reduces, or he stops himself from redemptions and waits for break even to happen, and the green dot shows that is the time when he actually withdraws, meaning that he just ends up making what he had put, or just equivalent to what a traditional fixed income product can give. And actually when he's supposed to withdraw, he actually has surplus money and he puts in more. So that's the investor investment cycle. Talking about the assets, one can invest in wealth preservers like gold, fixed income, insurances, and the other set is wealth creators, where one can put in real estate, in equity. In equity, also we have subcategories like passive equity, which is through the mutual fund route, and through PMS, portfolio management services. In equity, one can invest through the active mode, which is investments, trading, trading in commodities, trading in currency, trading in stock market. So one needs to have clarity, confidence, and commitment to make money. Meaning that until unless you're not clear about your goals, you're not committed to the investment amount and the investment time horizon you had invested with, you will actually not make money. And for that, you need to have clarity, confidence, and commitment. We've compiled a list of investors who are well-known international investors who've taught us a lot about how money works, how money management is supposed to be done, and they are wealthy, rich investors. So what common traits they had is that they had clarity, confidence, and commitment. India, the destination of prosperity. So we talk about the demographics of India, the population of 130 crores. We are as of now 60 crore middle class, 69 crore women, and 42 crore youth class. If we talk about the generation, the old age, middle age, and young age, so majority of them are young age, as we just quoted, 42 crores are approximately youth class. So we see a huge opportunity where the young age are having a worry free mindset. They have the buying capacity, they spend high, they really don't have any tension for family and work, and they believe in luxury. Professions have also changed from the past and present. So past we had very limited scope of professions, and today in the present scenario we have ample scope of professions. This is the life cycle planning. So planning is bringing the future into the present so that you can do something about it now. So as the child grows up, he actually starts thinking about his future, his or her future. When he graduates, he actually starts thinking about his or her children's future, education. When they're going to get married, they think about their daughter's marriage. And when you're going to retire, you think about your own retirement. That's basically the life cycle planning. We also need to understand the market cycles, different market cycles which are shown here. I'll talk about the economic cycle, where we show in orange the peak and the green is the recovery to peak cycle. So presently we are in the orange, where we peaked out and we are into the recession, and then the recovery cycle comes into picture. Well, what you need to do on the personal finance is just take care of this slide and you'll be done. Which talks about, one, you need to think about income from your investments, which is dividend income, interest from FD, post office, rental income, life insurance also gives you a regular income source. You need to take care of your debt, which is credit card, personal loans, home loans, any other loans. So get free of those on priority. You also need to think of the pension and retirement corpus if you haven't built, so it's time to build up on that. Well, they are wealth building investments like property, stocks, equity, mutual funds, wealth protections, instruments like FDs, bond, PPF, NCDs, and life protection, which is of utmost importance as of now, and always, which is term plan, health plan, and any safety insurance. So once you go through the slide and ensure that you have some part of your money into each basket, then your personal finance is well managed. You should have the vision to see, courage to buy, and the patience to hold. Well, this slide just shows the Berkshire Hathaway's, that's the Warren Buffett company, the 20 largest holdings. So even in the current time as we speak, in April 2020, post COVID-19 crisis, we are seeing that even Berkshire Hathaway's performances have dropped to almost 30-40% low. So there's no point of worry that my stocks or my mutual funds are not doing. Even the world's bestest investors have suffered due to this lockdown and COVID-19 crisis. The investment mantras which Warren Buffett teaches us is, one, you should buy a business, you should look at the risk reward ratio, you should look at the tax advantage, the long term, and the power of compounding. What Warren Buffett says is equity is equal to entrepreneurship, which is investing in a business which is like, it's not a regular source of income. It will always give you zigzag way of returns, but more than the fixed income. No risk means no riches. These are the type of risks: default risk, volatility risk, asset liability risk, interest rate risk. You can go through the slide at your ease. How to select stocks? So we talk about the economy, industry, and company. So obviously the economy as of now is not doing well. Similarly, all the industries will not do well. There will be select industries which will do well, and then the companies. They will not all companies will do well. Only select companies will do well. You should know how to make an asset allocation into large cap, mid cap, small cap, meaning that if you have 100 rupees, put 50 rupees in large cap, 30 rupees in mid cap, and 20 rupees in small cap, which is 50-30-20 ratio. There's something called as value investing, growth investing, and contra. Value investing is where the market price is almost equal or undervalued to the book price. Growth investing talks about which gives you good returns even if the prices are high and the demand is high. Contra is typically a different way of investing, in which investors actually take a contra bet, which is something like, in today's time you might feel that entertainment is not going to do well, the aviation sector is not going to do well, so that's called contra bet. Another interesting slide shows us that the market cap to GDP ratio in 2008, it almost dropped to 55%, and in March 2020, post the COVID-19 crisis started, lockdown started, we dropped to 51%. The market cap almost dropped to 102 lakh crores. As we speak today, we are at 130 lakh crores. The GDP of India is 200 lakh crores. So this is a famous parameter to judge whether the markets are cheaply valued, undervalued. So today we are uh, almost 51 to 60% of market cap to GDP, which means it's a good time to invest from a long term view. Well, one common question the investors is asking is it the bottom? So we saw the 1992 peak and low, that it went from 4546 in 1992 to 1980, 60% down, so on and so forth in 2000, 2008 and 2020. This slide shows the Sensex fall in last 20 years, the biggest Sensex fall in 20 years. But the common thing what we understand is that whenever the Sensex fall, the recovery was much higher. So in 2004, in 2000 we saw uh, from a peak of 5933, it went down to 2600 and it again peaked to 6027. In 2004, from 6194, it dropped to 4505 and then it peaked to 6234. So on and so forth. In 2006, 2008, 2010, 2015, we saw it peaking, we saw it falling and then reaching a new peak. Now we talk about, as on 20th Jan 2020, we see a peak of 42,000 odd and a fall up to 25,900 in it on 18th March 2020. So where are we heading next? This slide talks about the top 50 companies by market cap. So generally at this time, what we advise investors is to invest in large cap companies, because those are the companies which actually will rise before the small cap and mid cap companies. There are three type of market recoveries which one can expect. One is V shape, U shape and W shape. V shape means the level it fell to, the time it took to fell, in the same time it will rise like a V shape. U shape means it fell, it will stay static for some time and then it will rise in some time. A W shape recovery talks about the market fell, it rose, then again it fell and then it rises. So we are expecting a W shape recovery in this market economic scenario. Well, these are the sectors where one can concentrate or one can look at. But however, as we said, not all sectors, not all industries, not all companies will do well. So this slide we already covered in terms of the asset. One set covers wealth preservers, the other set covers wealth creators. So one can just look at splitting between these two. The focus area for investors is, have I made profit, have I entered into a loss, is there liquidity? So when we talk about equities, at least the good part is, irrespective of the profit and loss, there is liquidity. Now what is the learning out of this entire uh, exercise? So one, we understand that leaders are born in crisis. Lost money can be found again, lost time is lost forever. One needs to take care of the cash flow management, emergency fund, mediclaim term plan. They can plan the SIP and STP for the next 6 months and more. To make use of all these, you should use technology. Thank you so much. If you have any queries, please feel free to reach out to us.